Welcome to a weekly look at gold fundamentals with David Jensen. Welcome, David. Good to have you back after the holidays.
Yes, hello Jay, how are you?
I'm really good, and I trust you had a fine time with your family over Christmas and New Year's.
Yeah, it was great to have a little bit of downtime, that's for sure.
Yeah, it sure is. And but of course, a lot is going on even during the Christmas and New Year's holidays. Lots of things going on in the gold market, and we want to talk to you today about those fundamentals again. Lots going on in the UK, the LBMA, and we hear a lot of things on the mainstream media about manipulation and things going on in the markets, and you know, they would have us believe that they're going to fix everything now, and you know, being the honest fellows that they are, we're going to start getting some straight reporting and real true prices at the LBMA. What's your read of what's going on now, David?
Yeah, difficult to say exactly what is going on. We can see, gold has been rising in price along with the U.S. dollar, which is unusual. And seeing that rise in the gold price with the U.S. dollar, and then with the background of these changes that you're mentioning there at the LBMA, I'm wondering if things are changing at the margins enough to actually shift the trading patterns in gold. But I did note that link that you sent to me, Jay, with regard to the UK saying they were going to criminalize manipulation of gold,
Yeah.
silver, crude manipulation, as well as manipulation of interest rates. But the discussions that we've had have really focused on the fact that the nature of these markets are distortionary, and that unless you fundamentally change the market, I think they'd have to throw the whole lot in jail. Because by definition, what they're trading is virtual gold and virtual silver. And what they're creating by trading these virtual instruments, unbacked instruments, and levered instruments where they're being borrowed and resold over and over and over again in the market, they're creating a very large repository of gold and silver that just don't exist. And so, by definition, that would manipulate the price of gold and silver because it's creating supply. There's demand from sovereign investors, from institutions for very large positions of gold and silver, and they're creating this metal from nothing. And these investment houses and sovereign entities are sitting in these positions, which really are not backed by gold and silver at all.
Mm-hmm.
So I find this announcement here that they're going to criminalize it as kind of being, well, nice, but you've got a little bit of a problem here because the very nature of your institution is one which appears to be very, very manipulative in terms of moving the price because of the nature of itself.
Mm-hmm. So you have essentially people that think they are buying gold when they go out and buy, take a long, say, a contract to buy gold in the futures markets. But in fact, there's really no gold, or there's very little gold if they were to ever want to take possession of it. The difference is that virtual gold, the idea that having gold paper is as good as having gold in your vault. That's sort of the mentality of what seems to rule most of Wall Street. When I watch these guys on Fast Money or whatever after the close of the market, they're talking about going in and buying an ETF, GLD, or a futures contract. They don't seem to believe that it's essential to actually own the physical gold, and yet that's what these markets are supposed to be dealing with, right?
Yeah, exactly. And we're hearing these announcements from Parliament, from the regulators in Parliament in the UK, that they're going to start criminalizing this. I'm sure they're going to say it's outrageous behavior and we're shocked, and we can't believe that this is going on here. But I mean, what you have is, first of all, the LBMA in one of its presentations stated that they were 85% of daily global gold trading. And when we work backwards through the numbers, they do release their netting, end of day net settled trading, and we can work back by using the 10 times multiplier to see what the actual gross volume is. It's running about 207 million ounces a day in November, which is the most recently released numbers of gross daily trading volume. So when you have that level of trading, and it creates an implied open position. If you use a 2 times multiplier, you get 400 million ounces, and if you use a 3 times multiplier, you get 600 million ounces. And these ounces, I don't believe that they exist. They only fractionally exist.
Mm-hmm.
And through the use of leverage, borrowing and reselling devices, and through using unallocated devices, they've able to create this massive repository of gold, which is not gold at all. It's dream gold.
Mm-hmm.
And step right up, and you can have your dream gold, folks. And it goes hand in hand, really, with the central banking institutions that we have right now, which really we know that these paper currency regimes always result in failure. And they really are snake oil programs. They talk about using data-dependent decisions, and they need to create inflation to create growth. And we know that you don't create growth through inflation. It's a falsity, and it's chatter to really cover what they're doing, which is printing money without end, and these things always end up in currency failure and chaos. So I really look at this announcement of the criminalization of this activity. It's really window dressing, for the consumption of the masses who are starting to wake up to this.
Yeah, you say it's chatter. A lot of this talk is chatter, but David, you've got guys from Harvard, Princeton, and Yale with PhDs behind their name. They speak very, very well on television. They dress very well. They appear to be very intelligent, and they have quite an impact on the belief system of people. Mm-hmm. But I'd like to, maybe you can help put this in perspective a little bit in terms of the ounces, the paper ounces that are trading in the gold market, and I want to get to the silver market in a minute, but in the gold market, the number of ounces that are trading, supposedly trading, compared to the number of ounces that are produced in a given year for gold.
Yeah, globally, the global gold supply is around 90 million ounces a year.
A year?
Yeah, and they're trading 200 million ounces a day.
A day. All right. So now here's the problem. The mining companies are getting paid on the basis of that fictitious price that's caused by massive amounts of selling that can come into the market. Of course, there could be massive amounts of buying that comes into the market that could drive it higher, too, at any given point, I suppose. Why might that not be the case? Why might this not be an overprice? If I was playing the devil's advocate here, why might that not be? Why might we not have actually an overpriced gold market now instead of an underpriced? Because after all, David, people could go in and speculate on the long side as well and drive the price higher, right?
Well, they're not removing supply from the market. The LBMA is creating supply which doesn't exist.
Right.
And as a consequence, if you look at supply and demand, if you believe in the market structures of a decline in supply leads to higher prices.
Sure.
Then an oversupply would lead to lower prices. So that's kind of the first cut analysis that you can do there.
Sure.
But I mean, the issue here that I believe is that we have a deflationary collapse going on, as was predicted by John Exter, who was of the Board of Governors of the Federal Reserve, and he warned that unmooring our currencies from gold, untethering them, would ultimately lead to this over creation of debt through the printing of money, which is a debt-based money system. If you create endless money, you're creating endless debt, and that there's a deflationary collapse going on. And Greenspan says that gold is the premier currency, not a premier currency, but the premier currency that cannot be matched by any paper money that is out there. And so what is going on here is they're trying to cover the fact that gold is buying more and more goods as we progress through this deflationary collapse. And we can certainly see it. Paul Milcreast has a piece out today looking at the bond market and how the bond prices are rocketing and working down through John Exter's inverted pyramid. We would expect to see that's right on time, as well as a decline in in commodities as well. But gold and silver aren't commodities; they're money, and so you will see this money buying more and more with time. So the job is going to become more and more difficult. And as I mentioned just at the outset here, Jay, it's very interesting to see since early December that as gold has climbed in price from around the 20th of December, to be clear, of 2014, as the gold price has risen versus the U.S. dollar. The U.S. dollar has risen versus all other currencies, which means that we're having something odd going on here. That gold is outperforming all currencies right now in its increase in price, and it may be that at the margins that there's enough metal being removed from these exchanges that this paper cycling charade that they've been running is starting to fail. And as we mentioned, I think 2 interviews or discussions ago that you and I had, was that because of the gearing that's in that system there, it takes very little removal of metal to bring the whole thing down. It is really an unstable Ponzi scheme that's levered to an extreme extent.
And since it is a con game, of course, once people start to catch on, it's, everybody figures it out all at the same time, and then it's Katie bar the door in terms of the exchanging of fraudulent paper for the real thing.
Yeah, in the Old West, I mean, the snake oil salesmen, they'd pack up their wagons and head out of town at night because the local villagers were realizing that the snake oil that they were selling wasn't working. It's a little bit more difficult to do in the digital age. So I'm not sure what's going to happen here, but it certainly has our attention.
Well, it's interesting. I think last year gold rose against virtually all currencies other than the dollar, and now to start off this year, it's actually rising, or at least moving along with the dollar. The dollar continues to get stronger, as I think it's Bob Hoy that points out that the senior currencies with these deleveraging episodes, generally speaking, the senior currency is the strongest currency until the system obviously breaks down. The monetary system, the paper monetary system breaks down, and then essentially everybody jumps out of paper into real money. At least that is what I think will happen ultimately. Well, real money definitely is gold. There's no question about that. But I believe, in fact, very much so, that the second best money is silver. Let's take a closer look at silver, David. How is that shaping up now? Because silver has not performed nearly as well as gold over the last couple of years. We're looking at the gold to silver ratio approaching historic highs right now.
Yeah, it's around 75 to 1 versus over centuries of time it was 15 to 1. So it's the ratio of the gold price to silver is really getting heavily out of whack. But as we discussed last time, Jay, silver has for centuries been the day-to-day medium of exchange, and it is the one that you really want to clamp down on if you want to prevent the reintroduction of sound money. So you would like to keep people out of that. And I guess the other thing is that seeing that connection of Reuters, which has historically been a propaganda arm of the U.S. government, and seeing that connection is being maintained to the new silver fix is quite curious. It appears that the government has not let go of that of influence in that sphere. So, and looking at silver and the LBMA, if we look at November 2014, they were trading on a net end of day settled basis about 172 million ounces a day.
Wow.
And the LBMA's estimate from the gold market is they trade 10 times as much gold on a gross trading volume on a turnover basis versus the end of day net settled clearing volume. So that would imply that they're trading about 1.7 billion ounces per day of silver on the LBMA, and using a 2 times multiplier, again, we're looking at about a 3.5 billion ounce net open interest, or if we use a 3 times multiplier, you have about a 5 billion ounce open interest there. So, looking at mine supply of 800 million ounces a year, and total stockpiles of around 1.2 billion ounces, including all of the ETF holdings that are visible of refined silver. It gives us a sense there that if you have anywhere from 3.5 to 5 billion ounces of open interest, that where's the silver?
Yeah,
and it's a good question, but it's the same scheme again, that you use unallocated devices, and you leverage up on the ones that are there by borrowing and retrading the ones that are actually backed by metal. But again, then you end up with multiple claimees per instrument. And when the metal is withdrawn or to use Buffett's analysis of when the tide goes out, you're going to find out who's naked, and we may well be in the midst of that right now, judging from the markets.
Yeah, it certainly looks like it. Well, if I hear what you're telling me, David, it seems as though as leveraged as the paper market is in gold, it's probably even more leveraged to the actual production in silver.
I think so. Yeah, it's silver is it's very difficult to store, just through the aspect of the sheer volume of silver.
Sure.
The estimates are between 35 billion and 50 billion ounces mined throughout history.
Mm-hmm.
But yet we can only see about 1.2 billion ounces of refined stockpiles above ground.
Mm-hmm.
So the silver is out there in places, but it takes a while to get it refined into a fungible form.
Mm-hmm. Well, definitely storage is an issue, and one of the reasons, I suppose, why most people are so content to take paper rather than take delivery of the metal is that it is a pain to take delivery. It costs money. You have to have it stored somewhere. I mean, I'm looking, for example, I have purchased some OUNZ, my friend Axel Merck's ETF. And I could call them up. Supposedly, I could call them up and have delivery of my ounces of gold that are there in that 10,000 shares of OUNZ that I have in my account. Mm-hmm. Yeah, I could have my 10 ounces of gold delivered to me, and that's not such a big amount. I suppose I certainly could find space here to do it, but it's just a pain in the neck to do it. So I suppose that's a big part of it. It's not just a con game. It's the idea that if I want it, it's there, I can get it. It's, I think, only at the time when people start to say, oh my gosh, if I want it, they're not going to be able to deliver it. When that day comes, I think that is when the panic will set in, and that's when I think we'll see probably this scam being, when the naked bodies will be exposed by the receding tide.
Well, to stick with the marine analogy, lifeboats are difficult to store.
Yeah,
and they're a pain, and I'm sure that the skipper of the Titanic found them to be difficult to store. That was one of the reasons they didn't have adequate lifeboats. And he may well have had some certificates, paper certificates, in his back pocket that said lifeboats on them.
Yeah.
But those certificates didn't hold very many people.
No.
So it's you either have it or you don't. And it was a little bit frustrating seeing Kramer there on television last week, saying in his inimicable style, saying that everybody needs gold, but don't buy gold bullion and don't buy the miners, but buy the GLD ETF shares. That's
right.
What you need. Hold on to those.
Right.
So thanks, Jim. Another good tip.
Yeah. Well, it's another tip, another con tip, essentially, to keep people out of the real metal and to keep the game going. We've had
one comment there, Jay, is that by encouraging people not to buy mining shares as well, it hides the increase in the mining indices and keeps the awareness of gold down as well. So
that's
if you can funnel them into GLD ETFs, I think there's a lot of question about the ETFs out there, given all of the disclaimers on their prospecti.
For sure.
They're saying they can't be responsible for the activity of their sub-custodians, and it's all leading to the fact that they really don't want to promise you that they have the metal and that you can have the metal. So
right.
They're funneling people into paper and telling them to stay out of the real things in general. So
mm-hmm.
Where have we heard that before?
Yeah, that's part of the con game. We've had, on my radio show, we've talked to Jim Rickards on various occasions, and he's known for his notion that we are entering currency wars right now.
Yeah.
What are your thoughts on that? Where do we stand now? Are we in a currency war now? It certainly seems like we could be, with countries everywhere trying to cheapen their currency and get an advantage over other countries, much as happened during the 1930s, a beggar thy neighbor. So try to cheat against your neighbor by cheapening your currency. Isn't that going on now?
Well, Jim has done a lot of work with the defense establishment and notionally with the CIA as well on this whole modeling of financial warfare. And I really think that if we stand back far enough, we know that all fiat paper regimes collapse in the end. And the activities that we see in terms of debasement globally is a desperation scramble, and they're trying to keep their economies functioning because of this massive weight of debt and this massive amount of paper assets that are cycling through the economy. And so what's really going on is desperation monetary inflation. Now, what they're doing is they're addressing a problem caused by monetary inflation with more monetary inflation. So it's a bad idea for practical people. I think can see that that math doesn't work very well. But I really think we've got to stay. I mean, we've seen this pushing of the world towards conflict with Russia, and very interesting now to see Oliver Stone coming out and saying that it's clearly been a coup in the Ukraine, and the president of Czechoslovakia said that as well. And it's really gratifying for me to see these people standing up and saying this openly and clearly. The last thing we want right now is a war. We've got enough problems of our own to solve, and we've got to deal with them. And we need to address the underlying issues. So I don't really see this so much as currency war, quote unquote, but it's desperation inflation. Now, what we can see is the BRICS as a whole are moving back towards sound money, which is not very exciting to Warren Buffett and to the monetary establishment, because the real outsized profits can be created or can be really obtained, and other people's assets can be obtained during panics and during bubbles. So, I mean, that's really what we have going on here. If there was really warfare, I'd have to say it's of the financial establishment against sound money. That's where the warfare is really being undertaken. The rest of it I just see is almost comical scrambling and inflation, and double talk, gobbledygook, which really was brought to a new level by Alan Greenspan, but which is carrying on now. Certainly with Mr. Fisher there at the Fed standing behind Janet Yellen, and I mean, what a tag team the two of them are in terms of the stuff they're putting out on almost a weekly basis.
Yeah, it certainly is a lot of chatter, no doubt about that, and it keeps people diverted from what's really going on, which seems to be the game. Getting back to Rickards, I know that he has talked about SDRs, which would be, I think, just another sort of paper money, gold.
They called it paper gold in the 60s, and that's exactly what it is.
Yeah, and I would gather what he's doing, probably working with, being an advisor to the Defense Department and hooked in with the CIA, that he's basically trying to help the establishment preserve its privilege of theft. I don't know if Jim would be happy to hear me say that, and maybe when I have him on my radio show again sometime in the future, I'll put it to him that way, and we'll see if the sparks fly. But it's a very, I think, very deceiving, and I think that's what we try to do on this little discussion, is to try to help people understand what's really going on. And I want to thank you again, David. I guess looks like we've gotten off to a better start for those of us on the long side of the gold market this year. But who really knows? Who knows how far, how long they can keep this game going. We had on my radio show last week, I was talking to Michael Oliver. He looks at the technical analysis of the markets and says, "Wow," he says, "I think it's a given that we're going to see 1,600 on the S&P, and that's a minimum." And when I talked to John Rubino after that, John says, "Well, I'm not quite as sure about that," because he says the establishment can create $1 trillion just like that and go out and buy the S&P 500. So how can we be sure about that? So I think it's really hard to say, and it's all a matter of confidence. And when does the confidence break down? When you say that's the key, when does the system break down? When do people lose faith in the gods of the Fed?
Yeah, well, these rigged systems, they're natural systems ultimately that are played with, and when they fail, they don't fail in an orderly fashion. They cascade. And it's the cascading, and the same thing goes with the LBMA, is that when that rigged paper gold and paper silver market comes undone, it will cascade as well. So I agree with John Rubino that you can keep things going for a very, very long time with paper asset inflation. But you reach a point of failure where it just does not matter how much more you add, it's just going to fail. And that's the point that nobody really knows. Just like we don't really know the true supply and demand figures for gold and silver, GFMS and
World Gold Council.
World Gold Council. Between the two of them, they do a great job of asserting things, but nobody really knows. And so I think that what we're going to see here is reality unfold in the year ahead, and we're seeing indicators, we're seeing tremors in the stock market, and we can certainly see, if you look at the constant commodity index, has declined by 25% since March of last year, and that's a basket of 19 different commodities. So there is something. I mean, the U.S. dollar has strengthened by 25%, by 12% during that period, but the commodity index has declined by 25% in the U.S. dollars. So there is something going on there. So we're seeing signals that the status quo may not be so for very much longer.
Yeah, that thing that's going on that you're referring to, I believe you would agree, is probably John Extra's inverted pyramid, as money is coming out of some of those more speculative items and looking for safety. Well, you mentioned that they can keep the game going a long time. I would just suggest that they have already kept the game going a long time, given that 1971 was the date that Nixon took us off the gold standard, and it is allowed. Because we did have a more honest, I think, a more free market global capitalist system, at least in the West, up until that point of time, we were allowed and were enabled to perpetuate this monetary promiscuity for a long period of time. But one of these days, as you say, no one knows when it's going to come to an end, and that's what we want to be. We want to understand the fundamentals, underneath it, and that's, of course, why we have these chats every week. I want to thank you again, David. Anything else to add today before we conclude our discussion this week?
Well, just maybe the visual of untethering a currency from gold is very similar to untethering a large ship at a dock in a river. And when you untether it, nothing much happens at first because it's so large, it has so much inertia. But with time, it drifts away from the dock, and then things get crazy. And I see, Volcker's efforts to untether the U.S. dollar from gold backing. Really, nothing much happened at first for decades.
Yeah, good point.
But then it gets crazy, and we need to address these issues of the crushing debt that's out there, the distortions in the economy, and the inflationary impact of our central banks, and it needs to happen quite soon.
Yeah, there's no question about that, and of course, from 1971, it has not been a straight line relationship. You can see this sort of exponential growth in money creation and more frequent monetary crises that are occurring not only in the United States but around the world. So you have to think that we're getting much closer to some sort of cataclysmic event. Not that any of us want that, but we see it coming, and so we want to be prepared. And I want to thank you again, David, for helping us do that.
Thank you, Jay.